Hey there, everyone. Welcome to today's edition of The Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a rainy Redmond, Washington. Thanks for joining us every weekday after the close as we break down the market action using the best practices of technical analysis. The technical toolkit really is designed to help you improve your situational awareness. And I always coach investors. It's so important to have a good situational awareness. This was a mindset that I learned from learning to fly airplanes, where they taught you always have a sense of what's happening around you, inside the cockpit, outside of the cockpit. I find with investors as well, struggling at times to have a good situational awareness, a good market awareness. Charts are a really fantastic way of making sense of the world around you as an investor. What's working, what's not, what's breaking out, what's breaking down. Actionable movements to the upside and the downside. The best thing I would argue you can do is start on the StockCharts platform with the dashboard and go from there. Have that be the beginning, the table of contents, if you will, for a deeper analysis on all the charts. We talked about the conditions here in Redmond. I often, describe the weather briefly, and rainy is usually the adjective I'm going to use probably between now and next April, because that's the average weather we will get here. And I think what you have to remember, some of the seasonal tendencies, some of the cyclical patterns, that's sort of like your climate, right? That's the general tendencies. It's usually raining here in Redmond this time of year, but there are go those days where it's going to be a little brighter than normal. We're going to see the sun a little more. There are going to be days where it's not rainy. Maybe we get snow, or maybe we get drier conditions. And I think that's where charts can be really helpful. You have sort of that base case, what's probably happening this time of year, but then you have the actual evidence, what's happening right now. So have charts be sort of the version of looking outside the window and seeing if you can see the clouds or the sun or the rain or whatever. And hopefully stock charts can help you make that assessment pretty well. Growthy day today. Let's get right to our market recap, and we'll talk about some of the FANG sectors back at the top of the leaderboard. Before we get there, we asked you recently on our social media accounts and here on our YouTube platform, does the S&P 500 make a new all-time high before year-end 2023? Then it's not too far away. That means in the next couple weeks, we're making new all-time highs. Almost a 50-50 split, which I found fascinating, between yes and no, right? Now, getting to new all-time highs mean this sort of consolidation choppy period we've been experiencing here over the last week or two would have to resolve to the upside, or if we do get a pullback, it would have to be short-lived, because you'd really have to push higher to get up to 4,800 plus on the S&P 500. That's not an easy task. It's not too far away, 200 points or so on the S&P 500, but given the choppiness that we've had, that would actually be quite a different sort of feel to this market to see that renewed push to the upside. Now, if you ask me what would cause that to happen, it would be names like AMD breaking out, names like Alphabet having nice up days. That's what happened today. So let's get to the charts and see how things played out today. S&P 500 up about 0.8%, a nice upward follow through after yesterday's sort of distribution day, right? Yesterday we talked about that bearish engulfing pattern, opening higher, closing lower. Today bouncing right back up. So the S&P closing around 4586, we'll call it. The NASDAQ composite just below 14,400. That's up 1.4% from yesterday's close. The more value-oriented Dow only up 0.2%. So very much a growth over value feel to the tape today. We'll look at the sectors and you'll see some familiar FANG sectors at the top of the list today. Mid caps and small caps all up as well. In the small cap, S&P 600 notably outperformed the S&P today, up about 1.2%. The NASDAQ 100, of course, those mega cap growth names up the most, about 1.5%. And volatility actually increasing today while the market went higher. So a little counterintuitive feel. Usually we think of stocks up, volatility down, stocks down, volatility up. That is not a one-to-one perfect correlation. So the VIX actually pushed slightly higher, not much, right? Just above the 13 level on the VIX. Looking at interest rates, sort of a choppy day here overall for the bond markets. Bonds slightly down, and so the 10-year and 30-year points move slightly higher, 5-year points slightly lower. It was not a big move in the fixed income space today. So the 10-year yield essentially holding steady around 4.1%. Same for the 5-year point. The long bond is a little bit higher, around 4.25%. You can see the TLT, which is a Treasury bond ETF we like to track, down about 0.6%, and the dollar down about 0.5% as well. Sort of an interesting thing to think about, right? If you think about what has happened in sort of November, where you had weaker growth September, October, market bottom sort of third week in October, turns on a dime in a lot of ways, and November incredibly strong leading into strength that we're experiencing now in December. Lower rates, weaker dollar, certainly a part of that story. You're seeing more of that today, and I think that's That's part of the growth recovery phase that we're seeing here. Looking at the commodity space, the broad commodity ETF, the DBC, was up slightly, 0.2% higher. Same can be said for the GLD, for gold. Again, gold coming off of all-time highs around $2,100 an ounce, pulling back from there, and now still at the upper end of the range that we've been over the last couple of years. Silver price is down about 0.6%. Crude oil price is up a little bit, but energy still remains one of the weaker sectors, in recent months, and certainly on a day like today, just continues to find the bottom of the leaderboard day in and day out, I feel like. On the crypto space, Bitcoin down about 1% to 43,300. Ether price is actually having a decent up day, up over 5% to 2350. Looking at the sector returns, as I mentioned, it was growth over value today, and you can see the top 3 sectors, familiar, magnificent 7 sectors here. Communication services up over 2%. I mentioned news on Alphabet, and it's so fascinating to me, right? I mean, all it takes in this choppy environment is one big announcement related to AI in a company like Alphabet and just shoots to the moon. So if you think that AI frenzy is behind us, think again. XLC up 2.1%, in no small part on Alphabet moving higher in a pretty big way. Technology, the XLK was number 2, up 1.2%. Consumer discretionary, number 3, up 0.8%. Only 3 of the S&P sectors in the red today. Energy down 0.7%. The weakness in energy has been well documented on the final bar and elsewhere. We're continuing to see weakness in crude oil prices, weakness in energy. I think Sam Burns, one of my guests, I think that was on Tuesday's show, had some great points about the weakness in oil and sort of the implications of that. So if you missed that episode, make sure you watch that one from Tuesday's show. Utilities, second from the bottom, and healthcare as well, both slightly below Wednesday's close. Let's go to a daily chart of the S&P 500, just kind of check in on where we're at. So really the last couple of weeks have been a sideways period on that tactical time frame. We often think in binary terms, right? The market or whatever chart is either up or down. Is it bullish or bearish? And we rarely ask, is it bullish, bearish, or just kind of sideways? And if I gave you that third option, that's how I would describe the S&P 500, the NASDAQ 100 here. Really it's more consolidating. And it makes sense, right? You had the big run from the end of October through the month of November. I mean, pretty much just a consistent uptrend. Very few down days in the month of November if you look at it. But then the last 2 weeks have really been sort of sideways. The S&P has been between 4,550 and 4,600 around about. So we've sort of gotten up to that previous resistance from July. This is the green shaded area here. We have yet to break out. So the bull case for stocks, obviously, all big gains start as small gains, right? To get to a 15% rally, you first have to have a 5% rally and then a 10% rally, which means key resistance levels are good levels to watch, to wait for that breakout. Not happening yet on the S&P, but days like today certainly make it feel like that is a very real possibility as we go through December, one of the strongest months based on the seasonal patterns. If we would rotate lower, I have this red box here, this red rectangle highlighting the price gap that you had in early November. The S&P, the SPY, of course, the QQQ all have that price gap. That was when the October CPI number was reported. Stocks gapped up out of the open and continued higher from there. So if we would get a pullback, I think that's a real obvious line in the sand, a good level that, even as long as we hold that, things aren't getting that bad, right? It would just be sort of a pullback within a good uptrend. You start breaking that kind of level, that's where I would start to rethink about the overall larger structure. So what's happened is the S&P has reached 4,600. The S&P has become overbought, as has the NASDAQ Composite, as has many of the individual stocks we would talk about, and not just the growth stuff, things like financials and industrials and others, all getting to that overbought region. And that on its own is not a bad thing. Usually just indicates we're going to have perhaps a pause of sorts, which is what it feels like right now. If we would break down through some of these short-term levels, that's where it could be a little more of a corrective feel. But overall, it's sort of we've hit the pause button on the uptrend. Let's wait to see if and when we reinitiate to the upside. Now, just one other chart I wanted to show you from the Mindful Investor live chart list, and that would be new 52-week highs and lows. So we've talked a lot this week, just randomly. I feel like every episode we've shared one of the breadth charts to watch. And when I think about this market in an overall position of strength, I tend to like to think about a market as innocent until proven guilty or guilty until proven innocent. Really, it's more about the trend that we're seeing, the overall trend, and then allows you to have some wiggle room, right? So I think at this point, the market is innocent until proven guilty, given the strength off of the low in October. There are a number of things that tell me that, right? The strength in momentum, the strength in individual stocks that have had pretty good rallies, the fact that it's a much broader advance, and breadth indicators have reflected that. This is one of those, right? I mean, more and more new 52-week highs on the New York Stock Exchange. At the bottom, this is new 52-week highs for the S&P 500. I'm seeing a lot of green bars. I'm seeing very little red. Every green bar basically is counting the number of stocks in these groups making a new 52-week high on that given trading day. Any red would be a stock making a new 52-week low. Literally no stocks in the S&P 500 making a new 52-week low yet this week. That tells you about the strength, and quite a few making a new 52-week high. The largest number was here beginning of December, end of November. On that one day, over 10%, about 15% of the S&P made a new 52-week high on that day. Here's the net difference of new 52-week highs minus new 52-week lows, just a simple sort of momentum gauge, gauging the difference between new highs and new lows. It's all positive, right? So for the last 6-7 weeks, we've seen more new highs than new lows. So the reason why I'm showing all of this is overall, I think this speaks to the underlying strength in the market. If you are thinking downside from here, if you're thinking choppiness, which I don't think is an unrealistic expectation given how much of a run we've had, on this type of chart, you would want to see less green. You'd have to see some red with stocks being beaten down, but actually following through. You'd want to see a lot less green, meaning stocks are no longer making new 52-week highs. And the spread between the two ideally would start to favor new lows over new highs. That sort of reversal on a chart like this would tell me to start being a little more skeptical about further upside here. And going back to the poll question, I think stocks make new highs before year end as long as these indicators remain as constructive as they are right now. So important to keep that as part of your process to watch to see when those rotate. We'll do our best to keep you updated here on the final bar. Another one I want to show you, by the way, I forgot on this list is pure growth versus pure value. So a lot of people look at a simple ratio of growth versus value, and I don't mind that as a general sort of proxy of the growthy stocks versus the value stocks. The problem is there are a big chunk of stocks in the middle that actually are bucketed as both growth and value. So certain stocks, and I'm thinking like Microsoft is the example I would always come with, it's actually labeled as a growth stocks because it has a lot of those characteristics. It's in a growthy sector, certainly has upside from AI and cloud computing and all those things, but it's also an established company that has some of those characteristics of a more tried and true name that's more established. It's not in the early emerging growth phase. It's more in a mature growth phase. And so it's actually labeled as a value stock as well. There are these ETFs which track some indexes which are pure growth and pure value. So it eliminates the double counted names in the middle and looks at just the really growthy stuff versus the really value stuff on the other side. You can see this ratio is actually rotated lower in a big way and much more so than the growth, the regular growth to value ratios. I think this speaks a little more to the emergence of value. Today we have a really good guest, by the way, Jeff Hughes of JWH Investments. He's going to be highlighting one of those groups and one of those types of more value-oriented sectors really emerging with strength here. And I think that'll, when we talk with Jeff, it'll make sense as to why this ratio has been tilting much more to the value side of the equation here in November now into December. Just to finish off here, I think interest rates, of course, are a key focus. When I think about what has allowed the growth leadership to emerge, what's allowed days like today to happen, where you see growth stocks just continue to push higher, lower dollar, weaker dollar, and lower rates. If you look at the dollar sign TNX, that's the 10-year yield, you can see the gap down in early November, and then from there, it's just been consistent downtrend, right? So another thing I would be looking at, I mentioned, what would tell you that something's different? It's all about defining the trend, which I would say is positive for stocks, and then identifying what signals would help you identify a potential turn. Rates have been in a very consistent downtrend since mid-October. That changes, and I think we have something additional to talk about. So what's happened is bond prices have been rallying pretty good in November. That means rates are coming down. You see a rotation lower in the TLT or the AG, a bounce off of the 200-day, which is around 403%, we'll call for the 10-year yield. That could be a sort of a different feel. So in the month of December, you see a bounce in yields. That would tell me perhaps the major equity benchmarks have a bit of a breather to happen. To finish off looking at some individual names, I mentioned communication services at the top of the list. Alphabet, one of the top gainers in the S&P 500, up over 5% today. There's news from yesterday's close talking about the new AI product line that Google and Alphabet are rolling out. certainly with some broad implications. And it's such a great reminder that all you need to do is have a great headline involving AI, and there is quite a bid to be had. So we're seeing Alphabet push back higher. Now, from a technical perspective, let's be clear, I'm still unconvinced as to a breakout because we haven't broken out yet, right? Alphabet needs to get above 140. I think the RSI needs to improve more than it has. These last couple rallies, the RSI has stalled out around 60. The relative strength is not particularly good because other things have had a much better November than Alphabet did. So let's look for the breakout to continue. Nice gap higher on some pretty good news. I think the sustainability of the uptrend for the broader markets would have to mean a sustainability of a breakout on something like Alphabet. So Alphabet above 140, that's where I have an alert set. I would encourage you to do the same. Let's get excited when a stock like this is able to emerge from this basing pattern and make a new high. But so far, a higher low breakout would certainly be a pretty bullish development there. Second best sector today, technology. And in the semiconductor space, we have AMD up over 10%, or almost 10%, that is 9.9%. Now, again, AMD, very interesting. Just yesterday, it's sort of looking like a pattern of short-term distribution over the last week. Today, though, rotating very, very quickly, establishing what appears to be a higher low here around 116. Again, we're still below the June highs, and that's the issue with a lot of these growth stocks, is they're still below their highs from over the summer. I think, again, the market overall looks pretty constructive when these stocks can get above those resistance levels. Not there yet. Even with the 10% move, still below that high. One final group to highlight, travel and tourism. As I was looking at some of the stocks on the top of the leaderboard in the S&P 500, it's names like Airbnb. This is bucketed in the consumer discretionary sector. Again, this has really more been in a choppy environment here. It made a new swing low in October, sort of based there around 115, and now breaking out, testing the 200-day, resolving that to the upside. So today, sort of the latest upswing off of that October low. For Airbnb, I'm looking at that 150 to 155 range. Those are the highs from July and September. Getting above there on improving momentum would certainly be impressive. But overall, I think the characteristics are pretty strong coming off of that October low. Cruise lines, of course, pretty constructive as well. The concern I have for a lot of these names, like airlines, like Norwegian Cruise Line, is just the severity of the upswing. All of these names were basically oversold in late October, are now overbought, and in some cases extremely overbought with an RSI above 80. When that happens, I mean, that's what we used to call the good overbought, right? When something's so overbought, the RSI gets above like an 80, that tells you that the momentum is so positive. Looking back at June is probably a good sort of analog to think about. It means that the upswing is so strong. You may have a bit of a pullback for sure, but overall, most likely get at least one more leg higher. And that's what happened in July. You actually made a higher high before we started to see the signs of distribution, and we rotated lower. So again, travel tourism as a group showing a lot of strength, showing improved relative strength. I like what I see in those spaces. That's it for our market recap. We're going to bring on today's guest, Jeff Huge, in just a moment. Before we do so, a couple quick announcements. First off, we love to hear from you. We're going to do a mailbag segment probably next week, and we would love to feature one of your questions live on the air. As we're doing a live broadcast, you're welcome to use the chat that's built into YouTube. We'd love to hear from you there. We'll capture all those questions, put them in our mailbag as well. Email works just fine. thefinalbar@stockcharts.com. You can also put a comment below the YouTube video that you're watching. Don't forget to follow us on the social media outlets. @FinalBarSCTV on X is a great way to follow some of our programming and what we're doing. Want to let you know about a free webinar I will be putting on next week called 10 Questions Every Investor Should Ask. And it's really focusing at the natural year-end exercise. Year-end is a very natural time to look back and reflect on the year that happened. Think about your successes and some of your learning experiences, some of your lessons learned as an investor. I'll walk you through the 10 questions that I would encourage you to ask yourself. I will share with you my answers to those 10 questions. Great opportunity to think about year-end as an opportunity to reflect on what you experienced and plan for success in 2024. You can sign up for that free event at marketmisbehavior.com/10questions. We have a sale going on our StockCharts.com bookstore. A great place to get some gifts, early gifts for the holidays for investor friends or people that you hope can improve their investment decision making. We have a lot of great reads for you. One I would highlight is the Stock Traders Almanac. We had a great interview with Jeff Hirsch, who's the editor of the Stock Traders Almanac, last week on this show. If you go to store.stockcharts.com, search for the Stock Traders Almanac, make sure you use the code Almanac30 when you check out. You'll get 30% off the listed price. That'll be shipping out actually at the end of this week. good thing to get your hands on now. I've been following the markets with the Almanac for years. Highly recommend its benefits in helping you understand the seasonal tendencies. So make sure you check that out on the StockCharts store. I want to welcome on today's guest, Jeff Hughes. Jeff is the Chief Investment Officer at JWH Investment Partners, coming to us live from the Minneapolis area. Jeff, good to have you back on the show. Happy holidays. How are you?
Hey, I'm great, Dave. Thanks so much for having me on the show, and happy holidays to you as well.
No, it's good to see you again, Jeff. And thanks again so much for being a frequent guest on the show. I think our viewers have learned a lot from how you've sort of navigated these markets. We're at a really interesting sort of time at the end of the year. Obviously, a lot of strength in November. A lot of areas of the market that have not been particularly strong actually started to show some strength. We're starting with a group that you're looking at. This is an ETF ITA looking at aerospace and defense. Looking at the relative rotation graph, set the stage for us. What do you see here that you like?
Yeah, a couple things just to preface this by saying, Ned Davis Research publishes an annual sort of year-end rally sort of expectations, and their research suggests that industrials tend to be one of the big leaders in the Santa Claus rally near the end of the year. And so, it really got us taking a deeper dive into the industrial sector itself, which, as you could see on the far left, coming out of the lagging quadrant, it's starting to, reassert itself, right?
Mm.
But within industrials, the sector that stood out, or the industry that stood out the most, was aerospace and defense. And we chose the ITA, which is the iShares version of this. It's heavily concentrated in about 10 stocks. Boeing and RTX, I think together are about 36% of the index. The top 10 names, which also include Lockheed, L3 Harris, General Dynamics, Northrop Grumman, TransDigm, Howmet, Textron, and Axion, just to name them all. Those 10 account for about 76% of the market cap of the index. And so, we're very impressed with what's going on within that group of stocks itself. In fact, almost all of them are trading at new 52-week highs, and 5 of them are trading at or very near new all-time record highs. And so it's no surprise that ITA is really accelerating in terms of its relative performance versus the S&P 500. Both the momentum and the relative strength ratio are moving up and to the right, and we appear like we're on the precipice of crossing into the leading sector there with very strong momentum. And so, I think institutional investors who are trying to outperform the S&P 500 will be gravitating to sectors or industries like this that are making big, strong relative strength recoveries and trying to recover some of that lost alpha before year end.
It's so funny. I feel like how the market has evolved here in recent months, Jeff. But so many I think have mentally written off some of these sectors like industrials, financials, and others. We've been focused on the growthy stuff. Here's a group that actually is really starting to emerge. And it's a great reminder to use some good visualization tools to try to identify some of those emerging winners. We're looking at your weekly chart of the ITA. What tells this story here for you?
Yeah, there's a classic pattern base formation here that it appears that we've resolved to the upside above key resistance, and I'll define this loosely as a something of the cup and handle variety, right?
Mm.
And I think from a weekly perspective, pushing out above that kind of 119 weekly close sets the stage for a stock that could potentially rally significantly from here. Using kind of the measured move approach to identifying a price target, we'd see this rallying to at least say $136, possibly as high as $149. In the very near future, we'd say kind of a 1 to 3 month time horizon. You can see the lower panel looking at the MACD. Momentum has turned up. We've gotten a buy signal from the MACD on a weekly basis. This is a pretty powerful signal. Typically, it wouldn't surprise me if the ETF were to pull back and maybe just check back to that support level. I think as long as we hold above 115, we're in good shape. I think eventually we'll see a pretty strong move from here, just looking at the underlying stocks within that index and how they're behaving right now.
I give you a big thumbs up on your use of stock charts, as always, Jeff. But really interesting, and just so we're clear, using the unadjusted data, which is the right answer, 100% when you're looking at a value-oriented group. There's a dividend component that can cause some changes, and I think so many have been caught up in that short-term move. This really shows the magnitude of this breakout, just the amount of time it's taken to sort of get above here. With that in mind, your monthly chart sort of continues that theme, constructive here as well, right?
The bigger picture here is even more constructive. You can look all the way back to the early 2020 high that came in around $120, a little bit above that. And we've now carried above that. We've seen a monthly closing high that's taken out that level. We're breaking out of key resistance. And my suspicion is that what looks to on the shorter term basis to be a cup and handle like pattern is really a larger degree classic pattern base of the inverted head and shoulders variety. Nothing's perfect here. This is far from a perfect pattern, but when we think about the general considerations, we see that increasing volume, with these most recent moves up, and that gives us a lot of confidence that this is a bigger picture move. Also, the monthly momentum has turned up and triggered a buy signal as
Mm.
well. So we're looking at momentum on a couple of different scales, and we're getting the same answer, and that's always good news. From our perspective, the longer term upside potential looks like it could edge up to, say, 180. I'd even say stretch wise, maybe 185.
Wow. Well off the viewable area. It's a good reminder. I was taught never confuse the top of the page with resistance. So good application of the measured move concept, giving us an upside target there. Another area of the market that certainly had a run, now testing a significant, I mean, the resistance, right? All-time highs, gold. We're looking at your monthly gold chart. Talk us through your perspective here.
Yeah, first of all, I'll tell you that these two ideas come from our Alpha Insights weekly top actionable trade idea publication that comes out on every Wednesday. So we published our gold idea a week ago looking for this breakout, and we got the follow through here with a monthly close at a new monthly closing high above 2000. I think that level is going to fight its way through. They're really trying to push this thing back down. There is a lot of resistance there to get through, but it looks to me with that new all-time monthly closing high that gold's got a better chance now than it's ever had before to bust through this level. Now, momentum is diverging negatively, and that is a concern, but relative strength of gold compared to the other 18 commodities in the Reuters Jefferies Commodities Index looks very positive. We're getting a positive divergence there off of the prior low, and looks like it's carrying forward to another higher low. And so, I think a breakout here will fulfill that. We could see gold carry as high as, say, 2350 in the very short term,
Mm.
2560 longer term. I put out just kind of a general target of about 2500 looking out the next 3 to 6 months. I think that's achievable.
It's amazing how I feel like a lot of people, again, there's so many things that I feel like people have mentally written off, now really showing some renewed strength. Gold at new all-time highs. With that in mind, I was really fascinated when we were looking before we went live at this performance chart. Talk us through this slice of time we're looking at and what the results tell you.
Yeah, we started this performance review starting in November of 2021, actually November 8th, 2021. That's the orthodox top in the market. If we look at the value line geometric index, which is an equally weighted index of nearly 1,700 US companies that account for about 90% of all the revenue that's generated by all publicly traded companies in North America. So it's really one of the broadest and oldest indexes, goes back to 1960. And if we think about that date from November 8th, what's worked? Well, gold's up around 10%. Cash, looking at the 1 to 3 month T-bill, has produced about a 6% total return over that period of time. The S&P 500 is unchanged for over 2 years. The
Wow.
NASDAQ 100, the bell of the ball, is down 2% in that period of time. The Russell 2000 is down 22% in that period of time. And the Treasury market, the long bond is down 32% that period of time. Also, I would just point this out, Dave, and it's not in this chart, but if you take a look at the performance of the S&P 500 year to date through the end of November, 72% of the stocks in the index are underperforming the benchmark itself, and 41% of those stocks are negative year to date. It is a
Wow.
very narrow market.
It's fascinating. I thought this was a really interesting slice. I'm not used to, and I think most people are not used to seeing any performance chart where gold is far outpacing all of these other asset classes. So with this in mind, I mean, Jeff, with a group like Aerospace and Defense setting up so nicely, breaking out, gold certainly in a position of strength. We're seeing, broadly speaking, the markets going higher November and December. What's your outlook going into the first quarter? Do you find a new sense of optimism, or are you still sort of tentative about upside potential from here?
Well, I'll keep my remarks to this. I'm not optimistic about 2024 at
Yeah.
all. And I'll dig into it deeper when we talk about the 2024 outlook in a couple of weeks. But, I will say this about gold. Historically, if you look back over the last 500 years, and a guy by the name of Roy Jastrom published a book called The Golden Constant, where he evaluated performance history of gold for the last 500 years, and it's shown to outperform in periods of deflation and inflation. I think it's one of the great hedges, and people are so anchored to recent performance and things like that. They don't recognize what this asset class can do for a portfolio. We are significantly increasing our allocation recommendation to gold going into 2024, as we think it could prove to be the ultimate hard currency to own in an environment that could be both inflationary and deflationary at the same time. And that's going to require a much longer explanation than we have time for today.
Jeff, this was awesome. This was a taste, just a preview, hopefully, of our 2024 market outlook. I'm super excited you're going to be a part of that here later in the month of December. Look forward to sharing some of your thoughts for next year with our broader audience. But for now, I have to say thank you so much. Thanks, Jeff. Thanks again for being on the show this year. We'll look forward to more in 2024.
Always a pleasure, Dave. Thanks.
That's Jeff Hughes. Jeff's the Chief Investment Officer at JWH Investment Partners. He has a number of really good services and newsletters, Alpha Insights, Huge Insights, others he writes for institutional, also for retail investors. So make sure you check out his work. And also, he will be a part of our 2024 market outlook coming up here in a couple weeks with Ms. Schneider and also Julius de Kempener. I love a lot of Jeff's thoughts here, and great to highlight a group like the Aerospace Defense Group, ITA. And again, what's happened, I think, a lot differently in October, November, now into December. A lot of these groups that have done particularly poorly in 2023, having a tough time underperforming by many stretches, the growth leadership really starting to come into their own. I think going into next year, that's one of the big questions I'm going to have, and I know we'll want to discuss as a panel, is just the value side of the equation really starting to reexert itself. Is that an area to look at into the year to come? Great take, as always, by Jeff Hughes of JWH Investment Partners. We need to wrap the show, folks, and go to the 3 in 3, 3 charts in 3 minutes that tell the story of this market environment. Here is chart number 1. Playing on this theme we've touched on a couple times in today's show: value, growth, different time frames of a look back. I really love some of Jeff Hughes' longer term charts, looking at weekly and monthly charts. I can't stress enough how important it is, in my opinion, that many of our guests, again, not prompted to do so, they naturally are bringing up longer term time frames to try to make sense of the short term fluctuations. I'm just looking at the shorter term rally off of the October low, which is October 27th. If you look at the performance from there, out of the 9 capped here, sort of the Morningstar style boxes, small, mid, large, core, value, growth, the best performer is actually small cap value, but micro caps are up a little bit more than that. The micro cap ETF up 17% off of the October low. Small value, mid value, small core, the top 3 within those Morningstar 9. Large cap growth, actually the worst performer off of the October low. So while the year-to-date performance has certainly been growth over everything else, by any measure I would do, in the short term, you're really starting to see some of these other areas of the market improve. And that is a very different feel than we've seen earlier in 2023. Certainly a group of performance characteristics I would keep an eye on in the new year. Chart number 2, there's a couple different ETFs that track kind of this travel and tourism group. I'm using CRUZ, the cruise ETF. sort of covers hotels, airlines, cruise lines, sort of that general travel and tourism theme. What's interesting about the chart of CRUZ, if you look at the October 22 low, you take the high over the summer in July, we pulled back around 61.8%, right to $17 a share before rotating higher. This group is now broken back above the 200-day moving average, pushing onward and ever upward. I see a clear path back to the summer high at least. And again, these are areas of the market that have already had a really good run. But from a technical perspective, there's not much above a lot of daylight back to at least the July high. So I'm seeing a lot of strength. And this is an area that has dramatically outperformed over the last 6 weeks. Finally, a mystery chart. It's not much of a mystery because if you look around on the chart, you'll see the ticker. But I do want to point out and just focus on the price action itself. This is a chart that made a new low, a new 52-week low in September. Tested that support a number of times in late September, again in mid-October, broke out above resistance and the 200-day moving average, and now making a new 3-month high, which is one of my basic indicators I would look for. A trend line off of the recent lows. We're kind of right above that in this nice uptrend channel. Relative strength looking pretty good. Is this a type of chart you'd want to own? I would argue probably. Here's the problem. This is energy plotted upside down for the last 2 years. A lot of times, one of the great ways to sort of disconnect from your preconceived biases about a group, flip the chart over on StockCharts, just put a minus sign or a hyphen below the ticker. That'll just flip the data series over. And again, you're going to know what it is, but just look at the trends. Do a pure analysis based on the best practices of technical analysis. You might find that you draw an interesting conclusion that can help inform your ability to better manage risk in your portfolio. Folks, that's a wrap for the show. I want to thank you so much for joining us every weekday after the close for the final bar. A special thank you to Jeff Hughes of JWH Investment Partners joining us from Minneapolis. Don't forget to like this video and subscribe to our channel before you leave. For StockCharts in Redmond, Washington, I'm Dave Keller. Be well, stay safe, have a good night.